Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Hiran Amin. I think it's fair to say that nobody likes to lose. In fact, research into human psyche suggests the pain from losses can be more than twice as powerful as the pleasure from gains. This desire to avoid losses can weigh heavily on us when it comes to investing. It can lead people to sell their investments out of fear of losing their money or discourage them from investing at all. Well, here's a bit of comfort for the anxious investor out there. Long term investors may not need to worry about avoiding the next market crash. That's because history suggests that it's always a good time for investors to stay invested for the long term. Don't believe me? Then stay tuned. Our guest will make the case. Joining us is Dan Bortolotti, portfolio manager at PWL Capital and author of the book Reboot Your Portfolio: 9 Steps to Successful Investing with ETFs. Dan, great to have you back in our show, and thank you for taking the time to chat with us here today.
Yeah, it's my pleasure. Thank you.
So we're talking about the topic about long-term investing here, Dan, today. Now, I wanted to pick on your experiences first. You've worked with many different clients and spoken to them over those years as a portfolio manager. So what are some common reasons or themes that you hear about the hesitancy to start investing?
Yeah, I think it's a perennial problem with all investors. It's just part of being human. Anytime we, are preparing to put some money into the market, there's always some anxiety we're going to face. One of the times I think it becomes most obvious is if people receive some kind of windfall, whether it's an inheritance or they've sold a business and they have a large lump sum to invest. People will find that very difficult no matter what market conditions are. And this is one of the things that I've learned, just in my experience over the years, is there's never a time when it feels good to invest a large lump sum. And you will always be able to find reasons why it's a bad time. And the one, looking back, I still remember following the 2008, 2009 financial crisis. I mean, that was a terrible time. Markets fell about 50% in 6 months. And so people justifiably were nervous about putting money into the market, certainly during that period, which is understandable. And even, slightly after that period, because again, you never really know when the recovery has begun. And so people were saying, this is a crazy time to put money into the markets. They've fallen so hard. And then, fast forward a year or two when it was clear that the recovery was well underway. And people were saying at that time, well, I don't want to put money into the markets now because the markets have gone up so much. And I have to say, hey, let's take a step back here and recognize what you just said, which was I don't want to put money into the market after it's fallen. And I also don't want to put money into the market after it's risen. Well, when are you going to put money into the market? So you can always talk yourself out of it. And so that's why it's so important, I think, just to have kind of a long-term plan and then not focus too much on the timing of your entry points.
Absolutely. Yeah, I know. It's always a quandary we get ourselves in when it comes to making that first step. But we're going to unpack that through our conversation here. Now, before we get into that, though, I do have a trivia question for our audience. By what percentage did the average American investor's total returns underperform the investment funds they held over the 10 years ending on December 31st, 2021? We'll reveal the answer at the end of our conversation, so stay tuned. And with that being said, let's get into the meat of our discussion here today, Dan. So, first off, you're a big advocate for passive investing over the long term. So, can you break down for us what passive investing is and what's the rationale behind it?
Sure. So passive investing, which is also called index investing and sometimes more informally couch potato investing, the idea here is that you are getting exposure to virtually everything that the broad market has to offer, and you are not not occupying yourself with picking individual stocks or other securities, and you are not worried about market timing. So those are the two, sort of stock selection and market timing are kind of the two most common active investing techniques. With a passive investment strategy, your idea is just to be in the market all the time. But the goal with passive investing is, for example, if you want to get some exposure to Canadian stocks, instead of buying half a dozen of your favorites, you buy the entire market. And you do the same with the US market. You do the same with the international stock market. And you do the same with bonds to build a balanced portfolio. And you can use low cost index funds and ETFs in order to get that exposure. So there are plenty of funds available that allow you to buy effectively the entire stock market in any given country, and as well get exposure to virtually the entire bond market in your country as well for extremely low fees. And you assemble those components together in a balanced portfolio with a target of a certain percentage of stocks and bonds, and then you just hold it for the long term. And every time you have additional money to invest, you just add it to the portfolio in proportion to that target that you've set. And you don't get hung up on, is this a good time to add money to the portfolio, or should I, be buying individual companies rather than getting this broad exposure? So that's the basic idea of a passive strategy.
Yeah, I do like that because I think for the average investor, there's always two commodities we're always short of, and that's time and money. So this is something that can definitely fit well for those at least who are hesitant about investing. I wanted to talk about your book. One of the interesting arguments you make in your book is that it isn't worthwhile for most investors to take an active approach to investing to try and achieve better than average returns, or what we call in the market as alpha. So what do you mean by that?
So it's sort of based on two important ideas. The first one is that over the long term, and this is why we're going to talk about why it's always a good time to invest for the long term. Over the long term, the markets have delivered exceptional returns in the sense that any investor who over their lifetime earned a return close to the stock market averages would have achieved any reasonable financial goal, right? If you fail to reach your financial goals while earning market returns, something else was going on. You weren't saving enough, or some other calamity had happened to you that wasn't your fault. But the point is, if you can just earn close to the market return over your investing lifetime, you will almost certainly reach any reasonable financial goal. So that's number one. So, in other words, you don't need to try to get outperformance in order to meet your financial goals. You should just need to try to achieve the market return. Then the second part of that is, while you can try to achieve outperformance, it's extremely difficult to do over the long term. And whether it's mutual funds, whether it's professional money managers, over and over we see that outperformance over the long term is extraordinarily difficult to obtain after costs and taxes. And so you put those two things together. A, market returns are historically very good and good enough to achieve our goals. And B, doing any better is extremely difficult. To me, the logical answer is, well, instead of trying to do, not the impossible, but the extremely difficult, why don't we pick the low hanging fruit and just simply try to achieve market returns?
You talk about market timing can be difficult. So could you tell us why is it so difficult to time the market, and just how difficult are we talking about here?
While it might seem like an obvious thing to kind of get out when the going is bad and get back in when it's good, right? Actually doing that means you need to have some kind of insight that the market has missed, right? So that's the first thing. The second thing is, remember, anytime you do market timing, you have to be right twice, right? You have to get out at the right time, but you also have to get back in at the right time. And we definitely saw a lot of this, say, during the COVID crash of 2020. It took a little while for all the bad news about the coming pandemic to really filter into the market. So, for example, it would have been reasonable in February of 2020 to go to cash because things looked bad, and the downturn didn't really happen until a little bit after that. So, had you gone to cash in February, you would have been right, so to speak, and you would have saved yourself those losses. However, when did you get back in? Right? So if you got out in February, remember the market recovered very quickly after it bottomed out. And it recovered even though the situation was not that great from a health perspective, right? We were still in lockdown. It was still pretty miserable, but the market was going up. Well, you could have easily sat in cash saying, well, I was right. I got out, I missed those losses. There's going to be another crash. There's going to be another wave of the pandemic. The market's going to go down again. And all the while you were saying that, the market just passed you by. And when you eventually bought back in later in the year, you bought back in at a higher price than you sold, which completely defeats the purpose. So, this kind of thing is very common in market timing. You get out at the right time and you avoid some of the losses, but you miss the recovery. And that's the same, right? Over a long-term perspective, missing the recovery is the same as suffering a loss.
Some people might see how tough it is to beat the market, and they get discouraged from investing at all. They might feel it's simply safer to just save their money than invest it because, that way they're not going to be losing money on their investment. What's the problem with this logic?
Yeah, so the problem with this is, I mean, over the short term, it works really well, right? I mean, if you put money in a savings account or in a GIC, you won't lose money, right? And for a short term goal, it's an entirely reasonable thing to do. If you are investing for the long term, so if you're a young person now, you're 30 years from retirement, the problem with investing in very safe vehicles like savings accounts and GICs and nothing else is that you are unlikely to beat inflation over the long term. And so what you see over time is your purchasing power erode, right? I mean, you could have $100,000 today that could turn into $500,000 years from now, but inflation might reduce the purchasing power of that $500,000 to the point where it's not worth much more than $100,000 is today. And so in that sense, you haven't really increased your wealth. Conservative, safe investments have a place in every balanced portfolio. But if you want to achieve some long term growth, then you also need to look at things like equities, specifically stocks, to give you the growth that you need.
It's almost like inflation is that invisible tax that we have that it's not seen, but it's certainly the effects are felt there. Going on that note as well, it also reminds me of an expression about that goes something like this: the best time to invest was 20 years ago, but the second best time is now. So lay it out for us. Why do you believe that history suggests it's always a good time to invest for the long term?
So in any given year, we all know this, right? Stock market returns can be, you know, a 30% loss or a 30% gain. I mean, there have been years where we've seen both of those things. There's huge variance over the course of a year. If we take that out to 5 years, the difference between 5 year returns in history has been narrower than a year for sure. And keep taking that out 10 years, 20 years, 30 years. For many of us, we don't think in 30-year time horizons, but anybody who is, a young, even a middle-aged person today is probably investing for at least 30 years. It doesn't mean you might retire in 15 years, but hopefully you will live longer than that and your portfolio will need to last that 30 years. So let's have a look at, kind of the variability of returns over those kinds of periods. So even over a 10-year period, and we can use US stock returns here because the data is the most reliable. There have only been two 10-year periods since 1926 where the stock market has delivered a negative return over that 10-year period. So you're pretty confident that if you invest for at least 10 years, your chances of achieving a positive return are extremely high. If we go out to 20-year periods, there has never been a 20-year period where stocks have delivered a negative return since 1926 when we had the data. So we have about a century of data, right? And over that 20-year period, there's never been a negative return in US stocks, right? Now, if we take it out to 30 years, this is where it gets interesting. Not only has there never been a negative period, even the worst 30-year period since 1926 delivered a 7.8% annual return. That's annualized return. So over 30 years, that money grows to a pretty significant amount. That's an 850% total return over those 30 years. And that's the worst period. So this is why we're saying that if you are investing with a horizon of 20 to 30 years, what is happening right now in the markets is really not that important, right? As long as you get the money into the market. And again, most people are not investing all of their money on one day and taking it all out on another day. You're putting money in over time. So if you can just focus on the fact that every dollar you put into the market is going to grow over the long term, the individual entry points for each dollar that you're putting in are really not that important over the long term.
No, I like that. And that's a great question you did speak to, Dan, because I think if some people have commitment phobia, 30 years may seem like a long time, but you still have these different horizons that are painting the picture. And this is taking across the history of the financial markets going through those recessionary periods, those depression periods, I guess, in the early 1900s, right? And you're still coming out with generally more or less positive returns. So that's interesting there.
Yeah, I mean, again, it comes back to the idea where we said that you can always find reasons not to invest. Like, think of all the things that happened in history over the last 100 years, right? Two world wars, the Great Depression, and then more recently the financial crisis in 2008. The pandemic. All of these things, were devastating to markets in the short term. But if you keep focused on that long term, you'll realize that the markets have always recovered. And if you stick to the strategy for your investing lifetime, you will likely be rewarded.
Absolutely. Let's chat about that a bit because there's a lot of hand wringing about a possible economic recession. I mean, that's a little bit of a buzzword right now, and some investors might want to hold off investing until things, let's call it, settle down. Yet one of the interesting arguments you make in your book is that long-term investors don't necessarily need to worry about market ups and downs. Why is that? I know you alluded to a little bit about that, but if you wanted to add anything more to that.
If the vast majority of investors and experts and economists feel that a recession is coming soon, right? That expectation is already baked into the market. Okay, so that means that the market has either already, gone up or down, in price to reflect the consensus view. And so when we see markets react, sharply with a big bump or a big loss, that only happens when there are surprises, right? They don't happen because everybody knew a certain event was going to happen, and then when it happened, the market reacted. That's not how it works. So if we agree that markets only, really react strongly to surprises, and I think we can all agree that surprises by definition are not predictable, then it doesn't make sense for us to try to um, time our investments based on, news and consensus views. One of the beauties of diversification is that you include assets in your portfolio that react differently to different economic conditions. So let's use a simple example. If you hold stocks and bonds in a balanced portfolio, if we have a recession, especially one that maybe was a little unexpected, and the markets fall in value, stock markets fall in value, well, what else usually happens in a recession? Well, central banks, governments will tend to lower interest rates. When they lower interest rates, bonds get a boost. So that's why you hold them both in the portfolio. So when one goes down, the other may go up. It's not always that tidy. Certainly, there are times when both go up or both go down. But over time, if you build a diversified portfolio and no matter what happens in the market, something does well and something does poorly, then again, you don't have to be too concerned about when I'm putting money in because you're spreading that risk around and you're not really dangerously exposed to any individual risk.
Yeah, and you also give an example, which maybe you can take us through about, I guess we call him Bob, the worst investor. So could you take us through that one there?
Yeah, this was some research that was done several years ago. And the idea was they created what they called the world's worst market timer, who they nicknamed Bob. And they looked at if he had invested over 50 years between 1970 and 2020. And they said he put in $100,000 right before the major market crashes during that period. So I think we can agree that's about as bad market timing as you can get. And yet, if he had stayed invested for that whole 50-year period, even with that record, he still would have enjoyed an annualized return of just under 8%. So, I think we can all agree that no matter what kind of timing we do, it's unlikely to be as bad as Bob. Um, as long as you have a long term commitment to stocks and you get your money in, and leave it invested for decades, the entry points don't matter as much as people think, right?
There are many different combinations of investments that an investor could choose to make, and that could cause an investor worry about making the wrong choices. So, what does historical data say about the performance of different asset allocations?
So there was some great research done a few years ago by a researcher named Maban Faber. And what he did was he looked at historical returns for a number of kind of widely known model portfolios, ones that have been published in other books and things like that. And, among them, just the traditional 60% stocks, 40% bond portfolio. And he looked at these returns from 1973 to 2013. So it's 10 years old, but I don't think it will have changed very much if we were to extend that to the current year. What was really remarkable is that all of these portfolios were really very different. Some of them included real estate and gold, and some of them did not. Right? Some of them included, long-term bonds, short-term bonds, in various mixes. So they were quite different. And what he noticed was, if you broke down the returns by decade, not surprisingly, they performed very differently. But if you looked at all of the portfolios over the whole measurement period, what we found was the annualized return on all of those portfolios was remarkably similar. I mean, the difference between them was about 1.84% annualized from the best to the worst. So, what's the message here? The message is, any well diversified portfolio that you stick with over the long term is likely to perform well, right? But the second part of the message is, there will definitely be a lot of variance over the course of shorter periods. And if what you're going to do is put your assets into a diversified portfolio, and you happen to be one of the poorly performing portfolios for 5 years or so, and then you switch to another one that did better, you're just chasing past returns. And what's likely to happen in a situation like that is you're always fighting the previous war. So you're underperforming, then you're moving to another one which goes on to underperform, et cetera, et cetera. So I appreciate it's difficult to kind of stick with a strategy over the long term, but what I hope this study shows you is that, again, kind of any well diversified, thoughtful portfolio that is carried out over the course of several decades is likely to perform well. You just need to stick with it, even when it feels like it's not working.
Okay, we've established that consistent long term investing has historically performed well. That said, it can sometimes be a little nerve wracking for the investor just starting out. So, what are some ways that can help make this process easier?
Yeah, so there's a couple of things I think if you're just getting started as an investor, there's a few things, and one is, I think, to try to automate as much as possible. So, for example, if you're contributing, $500 a month to your investment account, try to do that in a way, use a service, where you can set up automatic contributions to a balanced portfolio. Transfer the $500 from your checking account into your investment account automatically, right? Set up a pre-authorized contribution. If you think you're just going to contribute $500 ad hoc, whenever you've got a little bit of money, A, you're probably not going to do it. And two, you're turning now everything into an active decision. Should I invest the $500 or should I hold on and maybe invest $1,000 next month when markets settle down, et cetera? So automate the contribution. Then automate the investment process as well. Get it into your diversified portfolio, in a way that you don't need to think about it. Workplace plans, if you have the opportunity to use them, are a great way to do that. Takes the money right off of your payroll,
Yep.
goes into a group plan. Sometimes employers even offer a matching contribution, which is great. If you can do something automated like that, it takes a lot of the decision making and the potential for mistakes out of the equation. The second part of this is, I would say, more relevant if you have a large lump sum to invest. So we talked about it at the top of the conversation, right? Like, and it could be something huge like an inheritance or a house sale or a business sale. But even if it's something just a few $1,000s to invest, and you're nervous because you don't have a lot of experience investing, and $4,000 or $5,000 is a big amount of money, and you don't want to put it into the market and see it fall 20% in a week. So what you can do in this situation is a strategy called dollar cost averaging. And this means taking the same amount of money and investing it gradually over some interval. So if you had $5,000, you might invest $1,000 a month for 5 months. So what that does is it smooths out your risk a little bit. So if the market falls the day after you put in your first $1,000, well, now you put in the second $1,000 when prices are lower. And so you're going to get kind of the average price between there. So this can really reduce regret, right?
Yeah.
It can reduce the risk that you're going to have terribly unlucky timing and put in all of your money right before a downturn. Okay. It certainly does not guarantee higher returns. In fact, over the long term, you're probably better off getting the lump sum invested ASAP, but it does reduce the risk of that kind of regret. And what happens is when people get burned by bad luck, they put money in before a market downturn, they can be gun shy and they might really be scared off of investing for quite some time. So we want to avoid that. We want you to be comfortable with a long-term investing strategy. And so to invest their money gradually like that is often a good way to do it. It certainly reduces anxiety.
All those points you mentioned really speak out to me on the fact of maintaining discipline. It allows you to be disciplined with your investing, which is key. And then, also creating that plan as part of that process, an investing plan that's going to help you hit those kind of targets there. Um, One of the great points you made last time you were on the show was that just because passive investing is simple, it doesn't necessarily mean it's easy. So, what are some ways that investors can work against themselves when investing for the long term?
One of the big challenges with passive investing is that people get started, they're enthusiastic about it, they build a diversified passive portfolio, and then they find it very difficult to stick to that plan. They want to tinker by adding, maybe an asset class here or there, or do a little bit of dabbling in individual stocks or something else along the way. So again, one of the ways to prevent that from becoming destructive is to try to keep your portfolio as simple as possible. There are a lot of products, for example, available now that allow you to build a diversified portfolio with just a single fund, right? And there have been for years. Balanced mutual funds have been around for a long time. Now there are balanced ETFs that do something similar for much lower fees. And the nice thing about these products is that they allow you to just simply make one purchase whenever you have money, and you don't worry about, should I put that money in stocks, should I put it in bonds, should I hold on to it and not invest? So it, again, removing those small decisions makes sticking to your long-term plan easier. And I think, frankly too, it does help if you are going to be a passive investor. It does actually help to learn a little bit of the theory, not only the theory behind it as an investment strategy, but learn a little bit about our own human foibles and our own, biases, right? The more insight that I think that successful investors understand is they are going to be tempted in predictable ways. And we all have certain biases and certain blind spots in the way we think, and to understand those and to anticipate them is often a very good way to ensure that you'll be more successful.
And in our technological world that we live in these days, I guess one of those key ones is FOMO. We're so immersed into social media. And do you come across that a lot, Dan?
Yeah, I think that there is a lot of, well, I mean, social media is so influential in many spheres, but investing is definitely one of them. If you want to think about long term investing, I mean, social media is the exact opposite of what you should be paying attention to, right? I mean, is anything in social media have a long term focus? I mean, as much as possible, try to tune out of those kinds of influences because they're corrosive. And it doesn't matter who you are, we're all influenced by them, right? We all experience FOMO to some extent. I think you build up a few calluses to them. Like I certainly now, when I see, people kind of boasting about huge returns, I understand that they probably, went to zero on a few of their ideas. You're just not going to hear about those, right? So people will boast about their wins and ignore their losses. And so once you get some experience, it's easier to ignore that kind of thing.
All right, fantastic conversation, Dan. We're going to have to leave it there for now. So, thanks so much for explaining why you believe it's always a good time to invest for the long term. Hopefully, our conversation has inspired some hesitant investors to get started and stay committed. Now, before we wrap things up, let's reveal the answer to our trivia question. As a refresher, the question was: by what percentage did the average American investor's total returns underperform the investment funds they held over the 10 years ending on December 31st, 2021? And the answer is: an analysis by Morningstar found US investors earned about 1.7 percentage points less in total returns on the average dollar they invested in mutual funds and ETFs during that time. The researchers chalked this gap up to poorly timed buying and selling of these funds, which cost investors nearly a sixth of the return they would have earned had they simply held on to the funds. That's a staggering loss of returns there, Dan. What are your thoughts on that?
Yeah, I mean that's a great example of what we've really been talking about during this conversation, which is um, there are a lot of examples of mutual funds that have outperformed the market over the long term. Not as many as you might expect, but there are certainly examples. But really, the question is, have investors in those funds enjoyed the return of the fund? And the answer, as you've just revealed, is usually no. And the reason for that is a fund may have a 10-year track record of outperformance, which it then markets, right? Our fund outperformed the market over the last 10 years. So what happens? People read the advertising or advisors put their clients into those funds. But then going forward, the fund no longer continues to outperform. So you're holding a fund that has a record of outperformance in the past. You just didn't enjoy that outperformance personally. So it's a classic example, really, of kind of poor market timing and investment performance chasing.
Absolutely. All right, we're going to leave it there. Any final thoughts you'd like to share with our viewers there?
Yeah, just again, I just want to encourage people to stay with that long term focus. I know it's difficult, and don't ever think that it gets that much easier because it doesn't. Right? It gets a bit easier once you understand it and once you've gotten your feet wet in the market. But it's a constant struggle. So try to stay on top of it and just do your best.
Absolutely. Well, Dan, thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on demand content available on the Learning Center and on our YouTube page. See you all next time.